is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Attention now turns to rate decisions from the ECB and the Bank of England later after the Fed signaled an end to more hikes may be in sight. We'll speak to the former Bank of England MPC member Michael Saunders in a special show, Bloomberg UK, in 30 minutes from now. Plus, the crisis deepens for Adani as shares sink, erasing more than $100 billion in market value since the sell-off began, while Citigroup Wealth becomes the second bank to halt margin loans on Adani securities. Let's check on the markets. The focus is the Fed rally that we saw really initiated not at the beginning of the press conference, but towards the end of the press conference when, of course, Mr. Powell was talking about financial conditions and also deflationary pressures. So this rally in Europe is actually continuing. He did say the central bank had made progress in its battle against inflation. So we also look at the treasuries. We haven't seen huge moves since yesterday, but something to keep an eye on. And then a little bit later today, of course, it's the turn of Christine Lagarde and the Bank of England. The main question, which a lot of investors for the FTSE and, of course, for the CAC and other major European benchmarks want to know is, OK, if they hike this time, what does that mean for March and going forward? When's the pivot for the Bank of England and ECB? So Fed Chair Jay Powell has warned that a couple more rate hikes are needed despite acknowledging progress on inflation. That's after slowing the pace of tightening with a 25 basis point hike.
We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
Well, we're now joined by Georgina Taylor, fund manager of multi-asset at Invesco Asset Management. Georgina, thank you for joining us. So the first thing I read when I come in, especially after Fed decision, is John Authers. He argues that it was a mistake for Jay Powell to be so dovish. Do you agree?
Good morning. Thanks for having me. I do agree, actually. I think that maybe it wasn't how dovish he seemingly was, but maybe how the market is interpreting it. And, you know, a couple of data points suggesting the direction of travel is right is very different to saying the Fed put is back in play and they will react very quickly with just a couple of more data points to suggest that inflation is coming down. And I think the jury really remains out on, you know, what level of inflation is acceptable, what level of inflation, and particularly what data points emanating from the labour market will be sufficient to say, you know, that battle is won. I think that's still ongoing. And we certainly think the rhetoric around central banks, the uncertainty, the reading, you know, and trying to extrapolate all this data on a forward-looking view is going to underpin, you know, a lot more volatility for all of us.
So, Georgina, do you think this is what the markets wanted to hear, or you know, Jay Powell wasn't on message and on target?
I think it's more that it's what the market wanted to hear. I mean, what's so interesting at the moment is that we do still seem to be anchored in the previous investment regime. So any suggestion that, again, the Fed put is back in play, that central banks will ride to our rescue once again, the market really grabs hold of. And it's something that we understand. It's exactly how we've invested over years and years and years, that feed-through mechanism from lower rates, and that will underpin a low discount rate, and therefore risk assets look great value again. It does worry me a little bit because I think the investment regime has changed. We are in a higher interest rate environment, and maybe central banks don't have that flexibility just to kick back in terms of lower rates going forward. So it's not a disaster by any means. It's not saying that the economies are collapsing around the world, but it's just to say, you know, that battle isn't won yet, and there are some growth risks out there still. And so there really is this tightrope that central banks continue to walk.
So, Georgina, what does it mean for how you want to invest in this kind of market? So are you expecting a correction in certain assets or certain classes where you want to get ahead of?
I think as we transitioned into this year, we really felt that those growth risks would come to the fore. I think what's happening really is that we're getting a slow drip feed of news flow. So it's not necessarily going to be the dramatic sell-off in equities, for example, as we reprice growth risk. It's just this drip feed, which just might mean we don't make much progress. So for us, from a risk asset perspective, we prefer credit because we feel at least you're getting the income there. The balance sheet risk is arguably lower than what we've seen in previous economic slowdowns. So maybe you get a bit more protection in credit. And then we look at relative value opportunities to say, well, maybe it's more about buying one market versus another to really look at the winners and losers in this type of environment. But at that risk asset level, certainly more credit than equity, and looking for our kind of select opportunities elsewhere.
What does this deepening crisis with Adani mean for bonds overall, Georgina? At this point, do you need to try and look on whether it's a systemic risk, or do you just ignore it for now?
I don't think you can ever ignore these situations. I think, we've been discussing whether it's a short, sharp shock and it gets dealt with very quickly, or whether risk premiums have to come back into markets, because it's a reminder that under the surface there are some of these risks, be that specific risks, but also obviously in this situation there is a link back to fiscal and government risk as well. So I think again it reminds us there's been quite a story around emerging markets, for example, and whether that's been the place to be versus other markets. And I think that just challenges that slightly to say what is the right price and what is that risk premium that should be embedded in these markets. So these are all things that we're grappling with as we move into the new year alongside the central bank narrative. So I think it just, it's a reminder that volatility remains.
And I like also amongst your most important calls that you prefer credit to equities, which you've said you also expect sterling to remain weak. What are you expecting from the Bank of England today? They seem to have an even tougher job than the ECB and the Fed.
A much tougher job, and I think they will hike today. I think that's pretty much baked in terms of 50, but the difference is whether they can turn dovish more quickly. And for us, you're right, that the mix is not very nice. We've got the inflation risk is there, the growth risk is very obvious. I think at the margin, I think they have tolerated higher inflation, if a growth risk really is coming through, and probably that's clearer in the UK versus somewhere like Europe, for example, where I think they're really going to very strongly stick to that inflation mandate and remain more hawkish. And so, again, looking at the risks and looking at, interest in the UK, we've got quite a complicated mix of kind of growth risks and inflation risks right now. So I think it just keeps sterling on the back foot. So we've got quite an interesting one looking at, say, the yen versus sterling and looking at some of these different currency crosses. So, I think it's the dovish tone that will be quite different from the Bank of England versus elsewhere.
And you also believe, it's the time to buy strong balance sheet companies. Given the earnings season that we've had so far that we're looking at, how will it play out?
Yeah, I think we are in a higher interest rate regime. I think that doesn't change. And under the surface, in pockets, debt levels have been rising, and there are areas of the market which are very vulnerable to variable rate, debt profiles going forward. So for us, that's concentrated in the US in this particular thematic that we have in the portfolios, and just focusing on stronger balance sheet companies versus elsewhere. And it's been doing very well as a theme, and we just think it'll do even better now as we embed and think about, well, what does this higher interest rate profile look like going forward for the corporate sector? So again, thinking about the world much more thematically, it crosses all sectors as well, as opposed to thinking in silos of sectors or even styles. That strong balance sheet theme is something that we think can continue to do pretty well.
Georgina, thank you so much. Georgina Taylor, Fund Manager of Multi-Asset at Invesco Asset Management. Now, coming up, we're counting down the ECB decision day. We're live in Frankfurt next, and this is Bloomberg. The European Central Bank meets in Frankfurt today for the first policy decision of 2023. A 50 basis point hike is all but fully priced in by the markets. Maria Tadeo joins us now from the ECB in Frankfurt. So Maria, it almost feels like the market already looking ahead to March. So what can we actually expect today?
Yes, Francine, and a lot of this is what I would describe as a forward-looking decision day at the ECB, because that 50 basis points hike, as you say, is fully baked in. It has been for weeks now. A lot of this, obviously, as a result of the language used by the head of the central bank herself, Madame Lagarde, in December. The question is what happens going into March, and that's when the press conference will be particularly important. Are we going to get a signal, be it soft or strong, that this is back-to-back 50 basis points from now, including March, or actually where there'll be some nuance in the language that could open up a debate from now until then. The other big point, which again will feed into this discussion, is how do they see the state of the European economy? And Francine, we've talked about it the entire week on this show, this whole string of data that we had. Inflation, headline inflation, yes, is down, but a lot of it is pegged to energy. Core inflation sticky. When it comes to GDP, a big debate out there. Can we escape a recession or not? That will be interesting too, and of course, heavily connected to the future path of rates going from here.
Yes, of course. Let's remind everyone. I know, Maria, you always remind us, your area, which grew to 20 members last month as Croatia joined. If you look at the data points that you were mentioning, GDP is not as bad as expected. We could probably avoid or have a very shallow recession if we don't avoid a recession. So does that point to more aggressive tightening because they can afford to, because the economy is not as bad as we were expecting?
Yes, and Francine, I'm happy you mentioned, of course, the GDP numbers, because the euro area did avoid that contraction at the end of last year. But a lot of that number was very heavily distorted by the Irish GDP. So the jury's still out as to whether or not this contraction will happen into this new year that's coming up. Now, when it comes to inflation, to remember, we did not get the print from Germany that was delayed due to a technical problem this week. We'll get it next week. So, of course, the data will be crucially important. I think that's why in this press conference you will hear it repeatedly. Where do you see the economy going, and does it still merit the fight against inflation? Remember, no pivot from Madame Lagarde. Is that something that she will repeat? To me, that's the one sentence that I want to hear again, and I will be paying close attention to. Is this again, no pivot, the fight is not done, this is not hit and remove, it's hit and stay the course.
Maria, thank you so much. Our Maria Tadeo outside the ECB in Frankfurt, a bit windswept, but always on point. Be sure to follow the ECB decision right here on Bloomberg, with the decision then set to come at 1:15 p.m. London time. Christine Lagarde's press conference, half an hour after. Let's get straight to the Bloomberg First Word News. Here is Leanne Gerrans. Hi, Leanne.
Hi, Francine. The stock rout in Gautam Adani's beleaguered empire topped more than $100 billion as a week-long fallout from a report alleged fraud continued to hit the group's stocks. Adani announced it's abandoning a $2.4 billion share sale to insulate investors from potential losses, with the offer price well below where shares are actually trading. The company has strongly denied the allegations in that report. U.S. House Speaker Kevin McCarthy says he and President Joe Biden can find some common ground on the debt limit after their meeting in the Oval Office. However, McCarthy says there was no agreement except to continue those discussions. The White House says President Biden also agreed to further talks to avoid an unprecedented default on U.S. debt. U.S. job vacancies unexpectedly jumped at the end of the year. The number of available positions climbed to a 5-month high of just over 11 million in December, up from 10.4 million a month earlier. The increase was the largest since July 2021, with a jump in vacancies in accommodation and food services. Economists had expected job openings to actually decline. New research suggests thieves stole a record $3.8 billion worth of cryptocurrency last year. According to blockchain analysis from Chain Analysis, overall crypto losses increased from the $3.3 billion stolen in 2021. The report says sanctions on North Korea drove a surge in suspected hacking by the Asian nation. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Coming up, we discuss the latest fallout from the Adani stock rout. So our interview with the ASK Group Chief Executive Officer. That's coming up next, and this is Bloomberg. The Adani crisis is deepening, with the sell-off hitting more than $100 billion. As we watch out for risk of contagion, a senior Indian minister told Bloomberg TV that the country's economy is resilient and can withstand the rout caused by allegations against the company. Well, joining us now is Sunil Rohokale, the chief executive officer of ASK Group, one of India's largest asset and wealth managers. Thank you so much for joining us, Sunil. We want to talk a little bit about the large infrastructure outlay and, of course, the budget. But first, are you worried? Are you seeing clients wanting to take their money out because of what's happening with Adani?
Not really, because clients have been seeing, listening, and watching the development on this particular event. But this is just an event, to my mind, because there was a FPO and hence got more highlighted, which finally now got decisively concluded by the Adani management. And I think the issue is behind. And I don't think there is any run on money as far as the wealthy families are concerned.
Right. So you don't think there's something systemic that's dangerous? We see a lot of Wall Street banks no longer accepting that as collateral, but you think it will be contained?
I don't think it is going to be any more contagious as far as Indian investments are concerned.
Are you getting questions about it? Do clients ask you what that means for their portfolio? Or again, do you think that the situation right now is under control, even in terms of questions?
In fact, we had a much more larger event yesterday than this particular event, which maybe everybody is keen on globally. But the most important event for India was the budget, because we are a growth economy. And every time there's a budget, there are a lot of anxieties, expectations, and the direction of the government going forward. So I think the whole of the energy of the country is behind the budget at this point of time, frankly.
Yeah, and yesterday, actually, we talked about the budget quite extensively. I mean, the numbers behind it are pretty incredible. This is a huge, large infrastructure spending outlay. What does it mean for where you think the money should go? If you're an investor today, what sectors and industries will benefit?
See, this particular budget is largely, I would call it, is very growth focused. It is very progressive. And it is the budget which is basically focused on job creation and consumption led. So this budget has put in a lot of emphasis on the physical infrastructure. Almost 4.5% of the GDP is allocated effectively for the capex, which is going to create a significant infrastructure in the country, and then the jobs. So roads, construction, railways, anything to do with the physical infrastructure related industries are going to get immensely benefited. At the same time, railways, 2.4 trillion is the first time India has seen in last 8-9 years, almost 9 times of the budget of the 10-year back. We have got the budget now, which means a lot to Indian Railways. So those are the two things which are going to create a lot of jobs for long term. And the youth, which is going to get employed, is the skilled, unskilled, and the semi-skilled in the whole part, which is actually the biggest part of the budget. The second part of the budget is actually the digital part of the budget. So the digital part of the budget also actually is creating a digital infrastructure, which is so important for a forward-looking India, which is going to lead the global growth now. So the 3 AI-based excellence centers, we have the one-stop shop of KYCs, digital lockers, digital data savings, which is going to be helpful. India has shown the world that how the fintech of India, unified payment system, is the best in the world, which actually now getting implemented in other countries as well. So I think a lot to do with the technology as well is going to be getting better.
How much foreign capital do you think India could attract because of this infrastructure push?
See, India as a destination has really emerged as an attractive destination. Last year, FY22, India has got $84 billion FDI investment. The next 5 years, the expectation is a $475 billion, close to $500 billion FDI, which is a long-term money which is going to come to India, going to stay here for long. And I think that is quite logical as well, because the growth rate of India last year, that FY23 projected growth is 7% of 7% GDP growth, which is anyway one of the best growth rate when the world at large is actually crying foul. Now, and it's going to be the same story going to be the next decade. So it is a golden decade for India in terms of growth cycle. India has become one of the prominent destination on a standalone basis in emerging market as an investment destination. And it is not a surprise that emerging market basket also India has now got a prominent percentage allocation as well. So very optimistic about.
Thank you so much. The ASK Group Chief Executive Officer Sunil Rohokale there with some really interesting thoughts, of course, on the budget and on the Adani saga. Coming up on our UK special, the former Bank of England MPC member Michael Saunders ahead of today's rate decision. That interview is next, and this is Bloomberg.
I would say that our focus is not on short-term moves, but on sustained changes to broader financial conditions. And it is our judgment that we're not yet at a sufficiently restrictive policy stance.
First phase was get to neutral. The second phase, I think you could argue, was to get into restrictive territory. Now they believe they are going truly meeting by meeting.
It may take time for markets to get used to rates at this level for some time.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Markets rally even though Federal Reserve Chair Powell says more rate hikes are on the way. The ECB and the Bank of England are expected to raise rates today. Deutsche Bank's profit and revenue come up short. That's after debt traders' long winning streak comes to an end. And shares of Meta are soaring as Mark Zuckerberg promises a leaner, more decisive company. We will hear from Apple, Alphabet and Amazon today. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Kailey, barely any time to look back at the really important stories of the Fed and Meta. We need to look ahead to the other corporate earnings from the tech sector and some big central banks reporting as well.
Yeah, this has been an exhausting week, and I can't believe it's only Thursday and we still have 2 days left to go with some really big potential catalysts, as you allude to. And of course, it also has been a busy week in Asia, specifically in India. I know usually I check across the Asian markets, but it's really India where I want to focus because the action is just so incredible when it comes to the Adani Group. It isn't bleeding through too much to Indian stocks more widely. The Nifty 50 is essentially flat on the day, but we are seeing massive losses for the flagship Adani Enterprises once again, down about 27% today after a 28% drop yesterday, which of course that drop leading the company to abandon its $2.4 billion follow-on shareholder and return money to investors. You also have Citi joining the likes of Credit Suisse yesterday and no longer accepting some Adani securities as collateral for margin loans. And you have some of the key debt trading at distressed levels. So it's really just pain that seems to be becoming more and more exacerbated across all of these different entities. Adani Ports and Special Economic Zones down another 7%. Adani Green Energy down 10% again. Over the last 5 days, we have seen about $100 billion in market value wiped off of the value of Adani's companies. Matt.
I am not exhausted because I am pumped. Wow, was that dovish yesterday? I mean, not only the step down to a mere 25 basis points, but you know, they're seeing disinflationary signs and they're really data dependent. So meeting by meeting. The S&P was up 1% yesterday and the cash trade, it's up 0.5% on the futures. Today, investors are buying bonds. That pushes the yield on the 10-year down to 340. We're looking at gold rising up now, 1957, the level there. And Bitcoin, which I was just about to drop from the boards because it was getting so boring again, starting to rise to almost 24,000 at 23,837. So the Fed gets dovish and risk assets rally. This is what we live for, right? I mean, this is the kind of, I don't want to say pivot, but dramatic turn that I think the markets have been betting on. This is why we've rallied so much from the October lows, Anna.
Right. I mean, yes, if you're not focused on the ongoing rate rises, and that was part of the conversation yesterday at the Fed, but the market, you're right, Matt, didn't listen to any of that. The market found what it wanted to find, and that was all of the dovish lines. And the lack of concern perhaps about financial conditions, that's certainly playing in here. European markets running with that theme, not questioning it too much and going with it, following Wall Street higher, essentially, here as we wait for the ECB and the Bank of England, but really responding to yesterday's rally on Wall Street. And there are some similarities. Tech stocks are doing pretty well today. That's because of some individual drivers around earnings. So Infineon, Dassault Systèmes, both reporting in the European tech sector. But really, it's that after-hours rally in Meta that's also lifting that sector too. And the Fed and that narrative also in focus there. These are some of the earnings stories that I picked out to mention to you. Santander is up by 4.5%, outperforming what is generally a quite lackluster performance from bank stocks today. But this business pleased the market with the profits it delivered. And the market not focusing too much on the so-called windfall tax. Some suggest it's that, although it is a tax on profits, tax on revenue, the chair of Santander was explaining to us earlier on. Shell PLC up by 1.8%. So this, the oil, the energy major business. Again, a story of beating expectations and increasing dividends and introducing a buyback. So reasons to be cheerful for Shell shareholders. DWS Group, this is the manager of money over at Deutsche Bank. And that stock, a worse story today, down by 4.9%. Outflows really in focus, even if the CFO told us earlier that it's the lower margin parts of the business that saw those outflows. The market is focused on that a little bit. And 109.95 as we wait the ECB then, Matt. It's been up to 110 earlier on this morning, as there now is this interest rate differential opening up. If we see the ECB go 50 when the Fed only went 25.
A divergence. This is what makes things exciting. And let's get to the Fed right now. Chair Jerome Powell acknowledged that the U.S. is in an era of disinflation with price pressures cooling, but he says there's more work to do.
We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
So he made a little move. Next up, the Bank of England and the ECB are going to deliver probably bigger moves. Today, we've got team coverage of Bloomberg's Valerie Teitel on the Fed, Danny Berger on the BOE, and Maria Tadeo in Frankfurt covering the ECB. Let's start with Valerie, though, to unpack Powell's comments. And he thinks financial conditions are tightening. I don't know what's wrong with his dashboard.
Look, I had to actually dig for a way to kind of explain how Powell is viewing the markets. This is the Chicago Fed Financial Conditions Index. This red line is what Powell is seeing. He's looking at the long-term tightening. This green line is what the markets are seeing. This loosening that we have seen pretty decently since the December meeting. But look, let's not get too caught up in that. What he is implicitly implying is that he does not need to tighten financial conditions meaningfully in order to have inflation fall quicker than forecast. And funny that we get their new forecast out in March. This tees us up perfectly for them to revise down their inflation forecast, revise down that dot, and pause in March. But look, that meeting is 7 weeks away. We still have a lot to go before then, including this Friday's payroll number. We also hear from Powell directly on February 7th. He is going to be speaking in Washington. What does he think about the market reaction after this press conference? And finally, it's not Valentine's Day, it's CPI Day. February 14th, we get the next inflation print. My eye is going to be on that core services ex-housing metric.
Ever the romantic, Valerie. Thank you very much. Please, Bloomberg's Valerie Teitel with a fascinating chart that you can find on GTV Go. We will try and get it into the chart bank for you, showing the tightening over the long term, the loosening in the short term of financial conditions. Now, over to the UK, the Bank of England is expected to raise rates by 50 basis points today. That will mark the 10th consecutive hike. Bloomberg's Danny Berger is outside the Bank of England. And Danny, the focus will be on, of course, whether we get that 50, but also the forecasts and the vote split.
Yeah, I mean, look, with the BOE, nothing is ever a sure thing. It's been a very split MPC, so that, of course, leads to some question marks. It's been, for the past 3 meetings, a 3-way split. But look, the data has been coming in that suggests they can't relent yet. They can't downshift like the Fed yet. Core services still sticky. Wage growth coming in at 7.2%. And we're likely to see an upgrade to their growth forecast in the quarterly review. That quarterly review they're going to release today is going to be really crucial for trying to read the tea leaves in how they treat rates going forward. The market, remember, at the moment is pricing in at least 25 basis points worth of cuts by the end of the year. If we get a different unemployment forecast, if we have stronger inflation forecast and growth forecast, we might be seeing an Andrew Bailey that tries to guide the market and tries to say this rate hike cycle, it is alive and it is continuing.
All right, Bloomberg's Danny Berger reporting from outside the Bank of England. Thank you so much. And now to complete the trifecta, the European Central Bank is also expected to hike by 50 basis points when it meets in Frankfurt today for its first policy decision of 2023. Let's get over to Frankfurt now. Bloomberg's Europe correspondent Maria Tadeo is there for us. Maria, how hawkish do we expect Madame Lagarde to sound?
Look, I think that's a big question, Kailey, because when you look at the actual decision today, it is pretty much baked in, priced in by the market. It has been for weeks by now that today the European Central Bank will hike 50 basis points. To some extent, this is a forward-looking story, and this is why the press conference will be interesting. Are we going to hear a repetition, a reiteration of Madame Lagarde back in December? Remember when she said this is not a hit and remove story, it's going to be a hit and stay the course story. The ECB is not going to pivot, and that would indicate soft or strong, doesn't matter, but it would indicate we're in for 50-50 back-to-back in March. If she doesn't, however, then that could open up a debate, perhaps some nuance into the rate path going into the March meeting. So a lot of the focus here is not so much on the decision today. Nothing is official, of course, until she announces it, but it really will be about the indications of March.
Maria Tadeo, never in my life have I been so cold as my days reporting outside the European Central Bank in Frankfurt. Why aren't you wearing gloves and a hat?
Can I... Listen, Matt, I feel, have you seen the movie The Sharknado? This is Sharknado, the German edition. The whole set is going to fly around. And this is with, what, 2 hours before decision making? So I still have a little bit here to go. But, you know, I take it I take it.
I hope the tent stays battened down there and your space heaters are working. Maria Tadeo reporting from, I'm sure, an incredibly cold ECB in Frankfurt. Now, let's stay there, but move inside to a warmer setting. Deutsche Bank's profit and revenue fell short of estimates, snapping a long streak of market share gains and trading in the final quarter of the German lender's turnaround plan. Despite the rare miss, the CFO, James von Moltke, says he's optimistic about the year ahead.
Against our guidance for the fourth quarter, we're probably a little bit short on revenues, mostly in the investment bank, but against what was actually a record fourth quarter in our FICC business nevertheless. So it was a little bit of the froth in the very end of the year went away. We're still very pleased with the performance and don't see that as any signal about 2023. In fact, the momentum has really continued strongly into 2023.
Bloomberg's Manus Craney joins us now for more. So some misses there, but von Moltke seems optimistic.
Hey, Matt. Yeah, optimistic. Spreads have compressed. We're risk on. He thinks they're going to make more than the $28 billion that they had originally guided in terms of the full year revenue. The froth came off at the back of the fourth quarter, and that's where the FIC business perhaps underwhelmed ever so slightly. And if you look at the advisory side of the investment bank, plummeting by over 70%. I think where the disappointment in the market comes this morning, down 5% at one juncture and more, having bounced off the lows of the day, is the fact that there was no material shift on buybacks. It's just too early. So that leaves them lagging the UBS, the UniCredit story of buybacks anonymous, which has driven this banking market this week. Without an additional uplift on the buyback, there's just a bit of hesitation. Undoubtedly, saving, you know them well, along with von Moltke, they have transformed this bank from the problem child of Europe, which is now very much the Credit Suisse dog days at Credit Suisse. So the transformation is there. The return on equity is in. It's at 9%. The target was 8%. And that emboldens the view that you may get a dividend uplift coming to play soon. But I felt a hint of caution from von Moltke. They just didn't want to be bounced into the big buyback narrative that the rest of the market has. It's still the highest yearly profit since 2007. And the dividend was popped by 50% today to 30 euro cents. It is warmer inside the Frankfurt Bureau.
Do not tell Maria Tadeo. She'll be very envious. Bloomberg's Manus Karani in the warm in Frankfurt. Thank you very much for that. Now, in other earnings news, shares of the Facebook parent Meta are soaring today. CEO Mark Zuckerberg is striking a new tone with investors.
I just think we've entered somewhat of a phase change for the company where we just grew so quickly for like the first 18 years of the company's growth. And it's very hard to really crank on efficiency while you're growing that quickly.
Bloomberg Quick Takes Alex Webb joins us now. I had to do a double take, Alex, of that pre-market move for business such as Meta, for the size of Meta to move that much pre-market, double-digit percentages. I read one piece by one of our colleagues, Palmy Olson, this morning, says Zuckerberg pulls Meta back from the brink. What was it that went down so well with investors?
It was really the TOTEX. Total expenses going to be £5 billion lower than the market had been expected. You pair that with a less drastic decline in revenue that had been expected. The market had been forecasting a 6% decline. It was only a 4% decline. You put those two things together, slightly better revenue, lower expected costs, you end up with a situation the market has taken very well. To be clear, expectations were exceptionally low. So any sense of upside, and there was plenty of reason for upside, was clearly taken very, very well.
Okay, Alex, so Meta down, Apple, Amazon, and Alphabet still yet to go. All three of them reporting after the bell today. Quite a trifecta. What are we expecting?
It's really going to be, in each case, looking on the outlook. Certainly in the case of Amazon, similar to Facebook, they'll be focused on how they're managing to rein in costs. They really opened the checkbook during the lockdown. Are they managing to rein in their costs? How is the cloud business performing? Microsoft's cloud business didn't do brilliantly in the most recent quarter. Is Amazon having the same problems? Going to be a similar narrative at Google. Is its advertising business holding up better than some of the others? Is it more resilient because people feel they have to be on Google search when they're advertising? And finally, when it comes to Apple, the expectations for iPhone sales are not as bullish as in other years. Again, any sign on the forecast for this year? How is resilience in terms of iPhone demand this year? Are they able to get all the semiconductors they need? Apple's got pretty tight contracts with their chip suppliers, which means they often get first dibs on supply. Those are kind of the issues for each of those companies.
Alex, thank you very much. Bloomberg Quick Takes Alex Webb with the latest on the tech sector. Coming up on this programme, we're going to be discussing all of these themes in detail. Joseph Little, HSBC Global Asset Management Global Chief Strategist, joins us. We'll look back to the Fed. How has this thinking around rate cuts changed at all for this year, post the Fed meeting? We'll also talk tech with David Kirkpatrick, Techonomy founder and author of The Facebook Effect. Really great voice to have post Meta with that incredible pre-market move. Plus, how extreme bets fueled an $11 billion fortune. Today's Big Take story focuses on Michael Platt, his outsized returns and some harrowing losses. Look for that online or on the Bloomberg terminal. This is Bloomberg.
Welcome back to Bloomberg Surveillance. We are simulcast on both Bloomberg Radio and Bloomberg Television, and I'm focused in on Adani right now. We're seeing the bonds absolutely tank across the empire. So a chart I've got up here shows green energy bonds, ports bonds, and electricity bonds all dropping down below 70 cents on the dollar. Meanwhile, a share sale has been canceled, a follow-on share sale to raise $2.5 billion because it was so deep underwater, and yet another bank says it refuses to take Adani assets as collateral for loans. Joining us to talk about this from a credit perspective is Dana El-Baltaji. She is Bloomberg's managing editor for credit. So, Dana, how serious is this for this gigantic business? When are we going to see a ratings downgrade?
My God, it couldn't get any more serious for a public company like this, to be honest. And especially since when you've got, I mean, you already have so much drama out there with the market cap tanking by more than $100 billion. But also at the same time, you've got bond coupons that are due today. So everybody's watching out to see if Adani Ports is going to actually pay off these coupons. There's no suggestion that it won't, but still there's a lot of focus on this because there's been a lot of drama over the last week or so. And you're absolutely right. The next step is there going to be a rating downgrade? Some people have said that it's been rather slow. I think it might come soon.
Right. So those are some of the very here and now questions we're asking, watching this story develop over the last week. And it's been interesting to see banks reevaluating what they will and will not accept as collateral in certain circumstances, including Adani bonds. Let me move on to the Fed story, because this, of course, looms large over your universe, over the credit markets. We were talking about risk assets in general responding to actions, maybe rather than words at the Fed. Does that apply to credit markets? What have you been seeing?
Oh, absolutely. And, I mean, the way that a lot of the market people are reading this, rightly or wrongly, is that we've had an entire year of extreme rate hikes, and now they've only hiked by 25 basis points. In comparison, that feels dovish. In reality, it's not that great for markets because, of course, the cost of borrowing is going up. But in comparison to the rest of the central banks out there, who we are expecting to see hike rates by like 50 basis points, the Fed looks dovish. And, of course, that has an impact on risk appetite. We are seeing risk appetite coming in. Recession risks are not being priced in as much as some people think that they should be. That could be good because some corporates can now come to the market and sell, and we've seen that. But it also could be bad because we also know we don't know what's coming, so recession might come.
Yeah, we've seen a lot of supply and a lot of demand, and we'll see how that develops as the rate environment tightens further. Thank you very much, Dana, for joining us. Bloomberg's Dana El-Battaji with the latest on credit markets and some of the themes playing into that. For the latest on those credit assets, you can check out MLIV Go, the market's live team across those assets and all the others on the Bloomberg terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. Ukraine fears that a new Russian offensive is underway. According to the New York Times, Russia is assembling hundreds of thousands of troops in Ukraine. It's also stepped up artillery attacks. All this comes at a time when Ukrainian forces are waiting to receive tanks and other weapon systems from the U.S. and European allies. Israeli warplanes bombed parts of the Gaza Strip early today. Officials described the targets as a chemical plant and a weapons manufacturing site for Hamas, which Israel describes as a terrorist organization. That comes after a month of bloody clashes between Israelis and Palestinians. North Korea has shut the door on talks with the U.S. over its nuclear arsenal. Kim Jong-un's foreign ministry also pledged to respond to what it sees as threats from the U.S. After firing off a record number of ballistic missiles last year, North Korea has been relatively quiet to start 2023. It's only tested one missile so far. Coming up, we'll turn from geopolitics back to macroeconomics in the wake of the Fed decision of yesterday, ahead of the ECB and BOA today. We'll talk all things central banks and the market response with Joseph Little, Global Chief Strategist at HSBC Global Asset Management. That's coming up. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Markets rally even though Federal Reserve Chair Powell says more rate hikes are on the way. The ECB and the Bank of England are expected to raise rates today. Deutsche Bank's profit and revenue come up short. That's after debt traders' long winning streak comes to an end. And shares of Meta are soaring as Mark Zuckerberg promises a leaner, more decisive company. We will hear later from Apple, Alphabet and Amazon. I'm Anna Edwards in London with Matt Miller and Kailey Leinz over in New York. And Matt, European markets going higher, following on from the Wall Street moves post-Fed yesterday. But US futures also looking ahead to further gains.
Yeah, we have futures up right now about 0.5% after the 1% gain on the S&P 500 in the cash trade yesterday. The NASDAQ was up 2%. Jerome Powell can say what he likes about the Fed's moves later on. But if they're truly data dependent, obviously, they really don't know what's going to happen. If we get a horrible jobs number, if we get a great CPI number, then they're going to have to pause or cut. So as a result, we see risk assets rallying today. Investors buying stocks, buying futures, buying bonds. That pushes the yield on the 10-year down to 341.46. They're buying gold right now, which had already kind of rallied into this. A lot of these assets, keep in mind, have been rallying since October. So we've seen seen the market discounting this Fed dovishness for quite a while now. I think yesterday's meeting, the comments on disinflation and the comments on data dependence, the waffling on whether or not they discussed a pause, all confirming what the markets had been anticipating and why the markets have been buying. By the way, Bitcoin rallying as well. And this also, I think, is just discounting a Fed pause or a Fed pivot, and has been for weeks. We've climbed up even since the FTX implosion to levels higher than we were at before that. Now we're at 23,810. So I guess the next stop is 24,000. Kailey, what do you see in terms of the pre-market movers?
Well, it's really all about Meta, as Anna alluded to. Massive, massive move in this stock for pre-market trading right now, up about 19% after it reported results. It had a smaller decline in ad revenue than was expected. It topped 2 billion active users. It announced a $40 billion buyback, and Mark Zuckerberg said 2023 is going to be a year of efficiency. So all of that seems to be music to the ears of both analysts and investors. We've seen a number of price target upgrades on the sell side, and investors clearly are bidding up this stock in a big, big way before the bell. And it's having a positive read-through as well to other big tech companies, including Alphabet, which, of course, that Google search business, also highly dependent on advertising revenue. So there may be a positive read-through there. It's up 4%, as is Amazon. Both of these companies, along with Apple, reporting after the bell today. So we still have a lot of weight in the S&P 500 getting set to report this afternoon. All of them, though, higher before the bell this morning, Anna, and that is lifting, of course, the broader markets.
Yeah, a real focus on tech then as we look back at Meta and ahead to those other numbers that are due out later on, as you point out, Kailey. And technology is one of the sectors lifting European stocks today. So tech stocks going higher, partly the read across from Meta, but also some of the specific corporate reports around the likes of Infineon and Dassault Systèmes lifting the tech sector here in Europe. The mining sector is under pressure, and that weighs on the London market, of course. Here's a sector in focus. That's banking. We've had a number of banks reporting here in Europe this week. Santander is outperforming the others today, up by more than 5% for the Spanish bank. The numbers coming in better than the market had been anticipating. Shell also delivering numbers that were better than anticipated, but topping that off with an increase in the dividend, an increase in buybacks, and that gave the investor community reason to send this stock higher. That as the company reports a record set of numbers for the past year, as you might expect, given how high we went on gas prices. The euro is at 109.84 as we wait for the ECB. Will they diverge from the Fed then with this 50 basis point hike? That is the expectation, given that the Fed only went 25. That's an interesting dynamic to think about, and we'll be watching euro dollar in amongst all of that then, Matt.
All right, let's get right now to Joe Little. He's a global chief strategist over at HSBC Global Asset Management. And Joe, you're joining us right in the thick of things here, post-Fed, pre-BOE, pre-ECB, post-Meta, pre-Amazon, Apple, and Alphabet. What's your take on this market? Let's start with the Fed. Did Powell confirm the market's expectations that they're going to be forced to pause or pivot?
Yeah, thanks, Matt. So I think we learned a few things from Mr. Powell last night. Firstly, this idea of disinflation being very much noted for the first time, especially in the goods area, which has been coming through in the data now for a couple of months. The change of pace, of course, away from 75 basis point, 50 basis point super hikes, now much more gradual approach with these smaller increments of 25 basis points. And then the third thing that stood out was this focus around super core inflation, or what Mr. Greenspan used to call super core inflation. So we're going to be focused, I think, intensely on the services sector, wage inflation going forward for some signals around what comes next with rates. You're quite right, though. The markets jumped on this idea of the maximum flexibility, the data dependency, and I think that's what's supporting risk appetite in markets.
Yeah, and Joe, good morning to you. There's always a lot of event risk around US data, but given the Fed with those messages that you highlight, perhaps there's even more event risk surrounding the data that we get middle of February, for example, around inflation and other things.
Yeah, I think that's right. Maybe the important additional element to reflect on after Mr. Powell yesterday is that when you're data dependent and when the Fed is saying we're no longer offering lots of forward guidance, we're not providing a clear pathway for what's going to come next, there is discretion to policy. That means that good news might not necessarily be good news from the perspective of the interest rate environment. Stronger growth numbers at this point in time can create further a challenge for the Fed, put them in even more of a policy bind, because it increases that concern around wage pressures, inflation becoming more entrenched, how central bankers talk about second-round effects. So I think it's a very difficult balancing act at this juncture. Some signals that we're seeing on leading indicators are already pointing to recession and risk of a downturn later in the year. There is a risk, of course, that the data comes out a little bit better, which might force the Fed to present a more hawkish message to the market. Some tricky issues to deal with.
Tricky issues there. Tricky issues at the Bank of England, no doubt, as well. We last time saw a three-way split in terms of votes on the MPC, the Monetary Policy Committee. We could see that once again. Which of the stories do you think is going to win out? I mean, this is going to be the 10th consecutive hike we see. Inflation running way above target, more than 5 times above target. But the growth outlook potentially being revised upwards by the Bank of England. Where do you think your focus is going to be?
Well, the data has got a little bit better. We've had some strong numbers on retail sales, the BRC numbers. We've had some stronger data on monthly GDP. But again, the stronger data almost makes the situation a little bit more difficult because the bank then has to reflect very keenly on some of the strong readings that we see in the labour market or the strength in wages. Private sector wages are going at 7% now, Anna. That's going to be a real significant concern for many people at the bank. So our feeling is that we're going to see still a continued hawkish message from the Bank of England. We have a feeling that the peak in rates could be something like 4.5%. That message seems to have been endorsed by some of the MPC speakers, particularly Mr. Bailey at some of his recent presentations. And that means, of course, there's a little bit more tightening still to come for the UK. But it's very, very difficult because we know that the underlying pace of growth in the UK remains rather lackluster, stagnation-like, while we still see these high inflation readings.
OK, Kailey.
Well, Joe, let's talk about Europe as well, because the growth picture has held in there much better than previously anticipated. How are you thinking about the ECB, not necessarily today's decision, but what's coming in March and beyond?
Yeah, so the ECB seemed to be a little bit behind at the Fed, maybe a little bit more aligned with the Bank of England in terms of the pace of the moves that they're making. More hikes is still a reasonable expectation. It's quite interesting that just as the inflation data on a headline basis is improving, we've had some better and better news on the inflation readings across Europe. The ECB language is getting a bit more hawkish. It's quite confusing, actually, at face value. But it's this same issue that the ECB faced that we've hinted at with some of the other central banks. The concerns around high levels of wage inflation, key point in the year now in Europe with the wage negotiations, wage settlements are going on. And the ECB want to make sure that some of that better news around growth, some of that those negotiations that are taking place behind the scene around wages, they want to provide a little bit of guidance, make sure that those pressures aren't becoming fully entrenched, more of a problem for the inflation picture. So we expect still a pretty hawkish tone to come through from the ECB. We have a target that's pretty much in line with where the market is saying at the moment of around 3.5% for the final destination for rates for the ECB. And it does mean that we should expect a continuation of hawkishness from the ECB. I actually think in many respects the European issues are a bit more interesting, more scope for surprise than in the US. The big issue is, of course, as the ECB are tightening at a dramatic pace over the last 6 to 9 months, that has some big consequences for the activity data, for money supply, for bank loans and similar data.
Joe, I've got to ask because you are a global asset manager, of course. What's the fallout from Adani? What kind of contagion should we expect? And are you still accepting Adani assets as collateral for loans?
Well, the outlook in Asia, Matt, is pretty different compared to how we see in the European economies or in the Western economies. So I think there's a lot to focus on in the Asia zone, the Asia region broadly, particularly with the developments around the cyclical recovery in China, much more benign inflation data, central banks in a less difficult situation as a result. So we're quite enthusiastic about the Asia region as still, both opportunities in stocks and in fixed income. And we've done some work on this.
But Joe, specifically on Adani here, they've lost $100 billion of market value in a week. You know, we're looking at some of the biggest institutions in the world saying they're no longer going to accept these assets as collateral. What's the fallout at HSBC?
I can't speak to the specifics about that, Matt. But what I would say is that the opportunities in Asia for asset managers, for investors this year, taking advantage of the cyclical recovery, the boomlet in activity in Chinese consumption, which is going to reverberate right across the region, are really interesting. And it does look quite interesting, the fact that it's such a distinct, desynchronized global situation at the moment, with a number of opportunities to play the cyclical recovery in this parallel world of how Asia is behaving relative to what we see in Europe and the US.
Okay, so the focus on the Chinese reopening. Joe, thank you very much. We appreciate your time. Thanks for coming in. Joe Little of HSBC Global Asset Management. Coming up, we will talk technology. David Kirkpatrick joins us, Techonomy founder and author of The Facebook Effect. What does he make of what we heard from Mark Zuckerberg last night and the pre-market moves in the share price? This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with former FTX U.S. President Brett Harrison. That's 11:30 a.m. in New York, 4:30 p.m. in London.
Currently, the monetization efficiency of Reels is much less than Feed. So the more that Reels grows, even though it adds engagement to the system overall, it takes some time away from Feed and we actually lose money. But people want to see more Reels, though. So the key to unlocking that is improving our monetization efficiency so that way we can show more Reels without losing increasing amounts of money. We're making progress here.
That was Meta CEO Mark Zuckerberg speaking on the company's earnings call. Shares of Meta are soaring in pre-market trading, up a whopping 19%, as Zuckerberg is striking a new tone with investors, saying the social media giant will be leaner, more efficient, and more decisive. Joining us now is David Kirkpatrick, Techonomy founder and author of The Facebook Effect. David, good morning. Thanks so much for being with us. Is it too early to call this a comeback?
Yes. I don't think we've seen it. Well, we've certainly seen a comeback in the stock. I mean, my gosh, it's double what it was just around a month ago. So, yeah, they hit a terrible low at almost 90 not long ago at all. And here we are talking about 180 going higher. So that is clearly, in financial stock terms, a tremendous comeback, historic even. On the other hand, they're still considerably less than half of what they were at November of 2021. And I don't think that the company's strategy has changed in the slightest. It's shocking how the metaverse continues an obsession. But something really good has happened to this company, and that is that it seems like Zuckerberg has decided to actually manage it as, a business, which ironically and oddly is new.
Well, and David, it felt like there was less talk about the metaverse and more talk about AI. How are you thinking about that?
Well, that's smart, and they have tremendous AI competency, as good as anybody. I think, we hear tons about OpenAI and ChatGPT. If Meta were to want to launch a product like that, I'm sure they have the capability to do so. It's obviously complicated, but they are extraordinarily gifted with talent in AI, and they're applying it in a lot of interesting areas. And yes, I think that's very important. The thing that was most interesting to me was this obsessive use of the word efficiency as sort of, the mantra. Zuckerberg loves to have a sort of very clear exhortative phrase that he uses for himself and to some extent for the company. And efficiency is the word of the year here, and it's needed. But the weird thing is, this was a company where money was flowing in like water for so long that they really lost the talent to just do what we would think of as normal business management. So now he's finally saying, oh, efficiency. Well, that is what most business people would normally think is important. But he's finally understood that. So there is another kind of turnaround there, I suppose.
I mean, he's trying to communicate, it seems like a cultural shift, David, because he talks about the first 18 years of operation, and they were growing like crazy, and they couldn't pay any attention to cost controls. But now, they're going to wipe out this useless layer of middle management that they've been overpaying for so long and really focus on the business.
You got it. I think your tone is exactly right for that, too. But it is healthy, and the company needed it. So I'm pretty impressed. And honestly, as you know, I have not been a positive analyst of this company for much of the recent period. I still think there's a lot of key issues that they continue to disregard, in my opinion, enough, and that is that we to spend enough time on, and that is, in particular, disinformation, hate speech in the 100 or so languages they operate in. But again, they are applying AI to that, and it's helping.
Well, don't they need that, David? I mean, if Howard Stern stops making like potty jokes, no one's going to tune into him. The same is true for Facebook, right? They need to be a shock jock of social media.
Now you're sounding like Roger McNamee. Hate, fear and anger are the things that motivate attention in social media, and they benefit from that, yes. On the other hand, I would love to see them be a little more conscientious about how their systems affect society. And to some extent, they really are. And they've been somewhat crippled in their inability to really stop it just because of their sheer scale, all these languages, et cetera. And AI is starting to help that. So, it's great that they have AI, considering the scale of the challenge they have, moderating a system with 2 billion people per day. I mean, just think about that, how hard that is. And that is another landmark that we heard them talk about yesterday.
David, I'm torn. I want to move on to talk about other tech names because we have lots of companies reporting, but I'm so fascinated by the scale of the move that we've seen pre-market in this share. I mean, the things you describe sound really interesting and like they'll mean something to investors, but are they enough to justify a 20% surge in a share price in a day?
I can't deny it's hard to understand why the market got so excited about what happened yesterday. I think it was probably, even though they say they're going to completely continue their commitment to the metaverse, and they lost over $4 billion in the quarter on that area of their business, the Reality Labs segment, the fact that he didn't talk about that much, and he said his focus is on operating the business more efficiently, that was such a refreshing change that I think investors were very, very excited by that. But it is such a historic shift of, in sentiment that it's kind of hard to explain, really.
Okay, David, thanks very much. Thank you for joining us. Good to get your insights. David Kirkpatrick of Techonomy. Coming up, we will discuss more on the tech sector, tech market performance with ARK Investment CEO Cathie Wood. She will be joining the team at 3:30 p.m. in New York, 8:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards with us out of London. Now let's get a look at what's ahead today. Following the Fed's rate hike, investors are awaiting clues on the path ahead for the ECB and the BOE, which are expected to both lift rates today. Then U.S. eco data, including factory orders, initial jobless claims, and durable goods will come out. And then, of course, more big tech earnings ahead. And what is being dubbed AAA, Amazon, Alphabet, and Apple are all going to report results after the bell. So it's hard to know really where to look, Kailey. I mean, we have the Fed, which we can obsess over ad nauseum. I'm sure, the rest will do that for the rest of the day. But then you have this meta move, which, as Anna points out, is massive for a company of this size.
Yeah, 20% in pre-market trading, which makes me wonder if we're also geared up for some outsized moves for these other mega cap companies that will be reporting after the bell today. I mean, that is trillions of dollars in market cap, the three of them that are set to report this afternoon. So how much will it be those earnings stories that drive the market action for the remainder of the week? And how much will it be the central banks, considering we think we kind of already knew, for the most part, what the Fed was going to do, and they met our expectations?
If you can put together a dovish central bank interpretation and something strong out of tech, then that certainly seems to send the Nasdaq higher. It did yesterday, and it looks as if it will do again today. Matt, we're also focused on central banks, of course. I think, the ECB clearly so important because of its size and scale. The Bank of England interesting because of the three-way split we could see. Really, our sympathies just all lie with Maria Tadeo, who is bearing the cold for us in Frankfurt this morning.
Yes, but also with FX traders, because we could see divergence that could drive some of these pairs. I'm watching euro dollar closely. I'm watching cable closely, and of course euro pound as well.
Yeah, absolutely. We went above 110 on euro dollar a little bit earlier on, even if it slipped just a little from that level. Now, that is it for early edition. Surveillance is ahead. They'll be hearing from Holger Schmieding, chief economist at Berenberg. Great voice to have on ECB Day. Stay tuned for live coverage of those central bank decisions and tech earnings. This is Bloomberg.